I'm Greg Hunter. Welcome to USAWatchdog.com. Coming to us from the West Coast, attorney Ellen Brown of webofdebtblog.com. Ellen Brown, thank you so much for joining us today on USAWatchdog.com.
Thank you, Greg.
You wrote a great piece recently, and I was been looking for somebody who really had a good analysis on the G20 meeting, because it was a pivotal meeting. It was in Australia, and you wrote a great piece about how they made a decision in the G20, and it will affect people with deposits and pensioners, because they're going to bail in. In other words, when they get into financial trouble, they will simply take pensioners' money and depositors' money. Explain, what is coming, and a lot of people don't realize that. The bank would never take my money. Explain what's coming down the road in brief, and then go into detail.
Okay, well, the G20 was actually established after the 2008 crisis, supposedly to deal with the crisis. So here we have all the leaders of the major countries coming together. They breeze in over the weekend. They rubber stamp this stuff that they really don't probably know exactly what they're rubber stamping. And they argue about things that are irrelevant, like the news usually does, do their photo ops and so forth. And then we are committed to these rules that this private body has established that goes back to there was a prior it's a Financial Stability Board that establishes these rules, and they are an offshoot of the Financial Stability Forum, which was formed after the last crisis in 1998, the Asian crisis. And then it was just an advisory body. But after 2008, it became rules that we agreed to actually implement. There was no treaty. Congress didn't agree to all this. So these rules they use words so that it's not obvious what they've just done. But what they did was say that basically we, the governments, are no longer going to be responsible for bailing out the big banks. These are about 30 banks, international banks. And so you have to save yourselves, and the way you have to do it is by bailing in the money of your creditors. Well, the creditors, the largest class of creditor of any bank, are the depositors. Now, theoretically, we, the depositors, are protected by deposit insurance up to $250,000 in the U.S., and it's 100,000 euros in Europe. But the FDIC fund has $46 billion in it, the last time I looked, to cover $4.5 trillion worth of deposits. And there are $280 trillion worth of derivatives that the five biggest banks in the U.S. are exposed to. And under the Bankruptcy Reform Act of 2005, derivatives go first. So they're basically exempt from these new rules. They just snatch the collateral. So if you had a big derivatives bust that brought down JP Morgan or Bank of America, there is no way that there's going to be any collateral left for the FDIC or for the secured depositors, which would include state and local governments, because they all put their money in these big banks. So even though we're supposedly protected by the FDIC isn't going to have the money. In fact, the reason they did the bail-in 2008 was that the FDIC didn't have the money. They didn't have enough money to cover the big banks that they thought were going to go down, that would have gone down if they hadn't come up with all these new devices for bailing them out with our tax money. So the whole thing won't work, but what it does is it makes it legal for these big 30 banks to take our money when they become insolvent. So they are too big to fail. Supposedly, this is supposed to avoid too big to fail, but what it actually does is institutionalizes too big to fail, because they're not going to go down. They're going to take our money instead.
You said there's like almost $4 trillion of insurance of dollars to insure, but there's much more than that in the banks. I mean, I think they have around $10 trillion on deposit, or 9.8 trillion, something like that.
Yeah, but only half of it is $250,000 or less. So the big depositors are like businesses that have to keep a lot of money for their cash flow, meet their payroll and so forth. Hedge funds, big players. And I just saw that some big banks are saying, they're telling their big depositors, we don't want your money. Take it out of our bank. We're going to start charging you for these deposits the way they're doing in Europe, because they have now these new requirements that make it so they can't really use them for anything, and they're going to have to come up with all this extra capital to cover it. So what good are, I mean, the banks are no longer doing banking. And I saw a thing on Reuters where they said, well, this is good because, oh, the new wrinkle on these new rules is that they're supposed to hold between 16 and 20% of their risk-weighted assets in either equity or bonds convertible to equity. Well, first of all, the bonds convertible to equity are the things that pension funds buy, and that's who they're going to dump all this off onto, which is us. So we, the people, are going to lose our pensions as well. But even that buffer is not going to be enough if the derivatives bubble pops. And nobody knows what's going to happen when that bubble pops. And it's obvious that it has to pop. It can't just keep growing. It's like, depending on who you read, but it's up to, as some people say, it's up to $2 quadrillion. It's virtual money, and it cannot keep going on like that.
If you take the Bank of International Settlements, it's 600 something, 700 trillion.
Yes,
That's a huge number anyway. The official number is a huge number.
10 times the gross domestic product of all the countries in the world.
Yeah, that's the lowball number.
Yeah, exactly.
What could go wrong? So, this could freeze up everything. We could wake up one day and, I thought I had 250,000. Let's say the schlub that has $15,000 in the bank, which is a lot of schlubs like me and, whatever, they may have, just not very much money, do they think they can waltz into a bank and give me my 15 grand or give me my 5 grand or it's going to be like Cyprus all over again. Your money's insured, but you can't have it. Isn't that what's going to happen?
Right. The banks will say, well, we don't have it. All the money goes into one big pool since Glass Steagall was repealed, and they're allowed to gamble with that money, and that's what they do. And I think maybe Bank of America is the most vulnerable because of Merrill Lynch. Everybody's concerned that they do very risky deals and they're on the edge. So they're gambling with, I think they have over $50 trillion in derivatives and over $1 trillion in deposits. So they're gambling with their depositors' money. What they do is they buy things like securities with them, and then they use that as collateral in the repo market, which they use like several times over. So it's the nature of a repo. It's a sale and repurchase. So the purchaser, which is the counterparty on some derivative deal, the purchaser has the goods. So if the company goes bankrupt, they're exempt from these rules. They just take the collateral and run, and they say, that's ours. The deal was we bought it, we own it, we're out of here. So that collateral's gone. So when we, the small depositor, go in and say, where's my $15,000? Then the bank will say, well, that's up to the FDIC. They insured you, so go talk to the FDIC. And then the FDIC will say, well, we had $46 billion. That's not enough to cover the trillion that just went down in Bank of America or JP Morgan Chase. So we're going to have to sue. They're going to be waiting in line along with everybody else in this whole resolution proceeding, which is not even a bankruptcy proceeding. It's just how we're going to resolve keeping this bank afloat with your money, and somebody's going to take the cut. So you can well see that, even in Europe, they recently agreed on a banking union, which was supposed to be a 3-pronged deal, where they would go for the government's money. The government pooled this money for a bailout fund, but before they could touch the bailout fund, they had to bail in money of their creditors. The same deal,
which is depositors.
Yeah, but the depositors were supposedly going to be covered by this Euro-wide deposit insurance. That was supposed to be the 3rd prong of the deal. But nobody could agree on the deposit insurance. The Germans said, no way, we're not going to insure the Greeks and the Cypriots and so forth. So there is no Europe-wide deposit insurance. So when they get to the bail-in and they take the deposits, then those banks or those depositors can only look to their own governments, which are broke. They're going to be broke just like Cyprus. That's the reason when these banks go down, the countries are going to go down. They are not going to have the money to pay back the depositors. They'll say, sorry, we just don't have enough money in the fund. Stand in line along with everyone else.
And that's going to be the same story globally is what you're saying. There's just not going to be enough money to pay off even the smallest depositors.
Yeah, and if you want to get suspicious about this whole thing, it looks like they set that all up. It's that sort of crisis response deal where crisis they set up a crisis and then they come up with this hasty solution. Well, we need to get all these big countries together so they can agree on some rules so we can fix this problem.
And it's not even a treaty. Nobody voted on it. They just decided, we're going to take your money, and FDIC. Could you imagine what the dollar would be worth if they had to print $1 trillion or $2 trillion, or heaven forbid, what's insured, just the insured amount, not 9 or 10 trillion, just 3 or 4. Could you imagine what the dollar would be worth if everybody demanded the government to print $3 or $4 trillion?
Well, the FDIC fund is supposedly has access to the Treasury, not for printed money, but as a loan. So they're supposed to be able to borrow from the FDIC if they the Treasury if they have to, which they did in the last bailout, a bit, a couple billion or a few billion. And then who's supposed to pay that back are the banks, because the banks they all contribute to this FDIC fund. It's supposedly supported by the premiums of all these banks. But the Dodd-Frank Act says that we, the people, are no longer going to be responsible for the big banks when they collapse, which means it's not clear that they'll even be able to, that the FDIC will even be able to borrow from the Treasury. But even if they could, let's say they borrowed $1 trillion, who is going to pay that $1 trillion back? That's going to bankrupt all the small banks that had to contribute to this premium. They'll say, well, we're raising your premium to, everything you've got, basically. The little banks will go out of business, and who's going to survive? The big banks. So what we're gonna have left is like 5 big banks, and everybody else is going to be bankrupt.
Oh, that's what you think? Holy smokes! You think that's what the plan is? Just to bankrupt all the banks? We consolidate the banking to just a few of the mega banks?
Well, whether it's the plan, you can see that that's the likely result. It seems to me. I mean, just assume a big derivatives bust, and many people are predicting that, and nobody knows what's going to happen when that does happen. It was the same sort of threat that made Congress get strong-armed into the bailout in the first place, the thought that everything was going to go down, that our bank accounts are all going to get wiped out. But really, if they're going to take our money, why are we keeping our money there? It seems to me there is a solution. We need to set up our own publicly owned banks. First of all, pull our public monies out of the big Wall Street banks, put them in our own banks, leveraging it for our own purposes, partner with the local banks, do just like the Bank of North Dakota does, which the Bank of North Dakota is the only state that escaped the credit crisis, and they would escape the next one. They're not. They do a little bit of derivatives, but they're nowhere near involved in derivatives the way that the big banks are. So we could all do that. I don't think they can't fix it with regulation. All these regulations are just making things worse. They're threatening, like that Reuters. I saw a Reuters article that said that, well, this is good because the 16 to 20% buffer, it could go as high as 25%. This is good because maybe the big banks will downsize and quit doing all this international things that they do. But those are the only thing they're good for. I mean, that's what we want them for, is the international stuff. You like to be able to use your Visa card abroad and have a big international bank that'll do all that stuff. So if they withdraw all that and they quit servicing businesses, businesses are the people that need a big bank that's international, because they do international business. So what do they have left? They're just going to be doing derivatives and gambling. I mean, they're going to have nothing left but their casino. We do not need these big banks. We need a secure banking system that's there to hold our deposits, to make safe and secure loans that are based on, a sound, the way the Germans do it. They have, I think, 70% of their local banking is done by, or their domestic banking is done by publicly owned and small local community banks, and they only service their local community. They know the local community. They know the businesses. They don't make bad loans. The only time they have gotten in trouble is when they expanded beyond their own local region so that they didn't know these businesses. So if you did the same thing where your banking is basically local, and the people doing the bankers know their local economy, they're doing safe, sound, old-fashioned banking, and our deposits would be, I could picture a system in which it's like just one big credit system. It's kind of like one big community currency where if it were one big credit system, your deposits would be 100% guaranteed. You wouldn't have to put a $250,000 cap on it. They'd be guaranteed by the Federal Reserve, or the central bank, which would be the backstop of this whole banking system that is for our benefit, and we get the profits of.
But the way you would set it up, it'd be more like a public utility. There wouldn't be any more. The Fed wouldn't really be the Fed anymore. You'd set it up like North Dakota, where this is a public utility. You can't do this. You can't do that. You have to, safely distribute cash and loans and hold deposits. That's it. That's what you do. You don't get to do derivative trading. You don't have a foreign trade desk. You don't get to gamble.
Right, and if people want to gamble, fine, they can gamble. If people want to invest their money in that sort of thing, great, let them do it.
Well, that's what Glass Steagall is all about, right? You want to be an investment bank? Great, you get no insurance. Do anything you want, but if you blow up, you go down. But they cut that, Bill Clinton, thank you very much, President Clinton, along with the Republicans and all the Democrats, that thought that was a great idea to erase the Glass Steagall Act.
Yeah.
Not a good idea. But you would treat banking more like a public utility.
Yeah, but you can't, some people say, well, the solution is reinstate Glass Steagall, do a Tobin tax, all this stuff. But all those changes that you make are going to totally upset the system, and they're going to complain. We got, a Republican government that's not going to go along with that anyway. But
the Democrats are going to go along with it. They're not going to go along with it.
Yeah, so if you change the rules, you're just going to make things worse. All these regulations that they put in place, they have no idea what effect they're going to have, and they do make it worse. It seems to me you've got to start all over. Like, we're not going to use those banks anymore. Don't forget about trying to support those banks. Just set up a new system that's totally clean, that doesn't take risks, and if you want to gamble, that's another system. You can go into that system, but it's not going to be government guaranteed.
It sounds like the Glass Steagall Act will be reborn. Do you think we're going to have a crash in order for these to get fixed? And you're basically saying, listen, the system is poised. A lot of people say the system's going to crash. It's all there's. Big best-selling authors. I know you're an attorney. You write a lot about the economy. You're in a good group of people about that there is going to be a crash. It is unsustainable. We will have a crash. Obviously, the G20 members, this year.
Why are they doing all this? They know something's coming. Yeah.
And do you think we're going to have a crash soon in 2015 or so? Do you think that's when it happens?
Yeah, I don't know. I'm not real. I don't know about predicting, but yeah, I would say soon. And they're certainly preparing for something, and it can't go on. It's like mathematically unsustainable.
And what would you do? Would cash in hand, dollars or euros or rupees or whatever, would cash in hand be something that would be, would work really good for a while? Bob Moriarty of 321 Gold said this a few years ago, and he started out with a piece because he's got 321 Gold. He's got a gold site. He says, I'm going to make a lot of people mad, but cash is going to work really good for a short amount of time. Do you agree with him that you should have cash outside the system?
Yeah.
Paper dollars, paper whatever?
Right, mattress is not so good, but a safe in your wall somewhere is a good idea. Yeah.
So you would tell people, don't keep so much money in the bank; they're not paying any interest anyway. Is that a safe?
Yeah. So I got 15 cents on my bank account last month. I looked to see what I got for interest. So that 15 cents shows that I am a creditor of the bank, or they wouldn't be paying me interest, right? So for 15 cents a month, I have the privilege of being bailed in, having my money bailed in, because I am now one of the investors in the bank rather than a depositor or a bailee.
And you
bail your own.
And what would you tell your family and friends to say, hey, I've got $5,000 or, I got a few $1,000s in a bank account. Would you say, you did take some of that out and keep it at home? Is that what you would tell people?
Well, in truth, I think, you need a bank account because you want to write checks. How are you going to pay your bills? You don't want to trot down to the office with your cash every time. But the minimum, the minimum necessary to cover, something you can afford to lose when the big crash hits, or move it into a local bank, which aren't covered by these rules. They still could get in trouble because they're all interconnected. There's this whole liquidity thing that goes on among all the banks. But there definitely would be a safer bet. I have a small business publishing company, which is in another state, and so I need a larger bank to do that. But I don't keep much money there. I just keep what I have to.
So that's what you would say. Just keep what you need. Obviously, you need a bank account. We can't go back to the Stone Age. You walk in with a bag of silver and put it down. I'm ready to pay my utility bills. But you would say just keep the minimum and keep some cash at home. Is that correct?
Yeah, well, the cash at home would be for emergency. I mean, just like you can keep some gold at home, some silver at home, but you can't really take your gold coins to the grocery store. You need something that the grocer's going to recognize on short notice.
And so you'd have cash. You'd have some cash outside the banking system. I mean, that's what you would tell your family and friends. Have some cash outside the banking system and be ready. Because I've been telling people, one of these days, and I think it'll be before the president leaves office, President Barack Obama, he's going to come on some Sunday night and say, my fellow Americans, tomorrow the banks are not going to open. But don't worry.
Exactly.
Do you think so?
Yeah, that's what Roosevelt did. But I do think when that happens, actually, we've changed this. I wrote an article on this that I never posted. We've changed systems every 20 or 30 years for 300 years. So every time that we have a crisis like that, what they do is they change the rules and they say not to worry. Like, for example, in 1933, Roosevelt closed the banks, and when they opened, he said, new rules. We're off the gold standard. The banks don't need gold anymore. Now we have this synthetic reserve system where they can get reserves from a central bank that can create as many reserves as we need. So that's what they'll do. They'll come up with the new system. And that's why I keep writing, because I would like to suggest what the new system should be, something that will actually work. So hopefully we're not going to have another system that only lasts 5 or 6 years like this last bailout.
That's right. That says it only lasts 5 or 6 years. I mean, you're looking at 7 years, maybe by 2015. Yeah. Some people say that it's going to come due in next year with all the the stars are going to align for some very nasty situation next year in 2015. Listen, Ellen Brown, thank you so much for coming on. I know you've written books about public banking, which in effect treats banks as utilities. I'll link to your books in your website on this interview. Ellen Brown of Web of Debt blog, ellenbrown.com. Thank you so much for joining us today on USA Watchdog. Great guest.
Thank you, Greg.